This week on the podcast, we're going to talk about tax efficiency funnels and that ticking tax time bomb that we spent some time talking last week with our special guest, David Walker. So let's get into it here this week on The Roth Guy.
Flying high above the metropolis, it's The Roth Guy with holistic wealth advisor Jude Wilson.
Hey, everybody, welcome into the podcast. Thanks for hanging out with Jude and I as we talk investing, finance, and retirement. And Jude, we're going to kind of do a follow-up now. So we had David Walker join us, which was awesome for a couple of episodes.
Yeah.
Highlighted some things. So let's now break it down a little bit more and talk more about that tax time bomb that's out there. And look at some tax efficiency funnels, maybe do a little sample study here as well for folks. So maybe get a little bit more meat and potatoes into this one for folks. How you doing this week?
Man, I am doing great. I am so excited because it's like we highlighted the problem and now we're going to talk about some action steps and solutions.
Yep.
So we're not just making people scared.
Worried. Yeah, exactly. There's enough of that right this minute. That's for sure.
Exactly.
So we're taping this here a little bit later in October. This will come out right around the beginning of November. So we'll also have a whole new set of tax things that could be changing because we don't know who the president's going to be at this time. So that could totally change some of these things that we're going to talk about. But I think fundamentally this stuff's still going to apply. So whether you're catching this in November or you're catching this 2 months, or you're sometime in 2025, there's still some stuff in here that's certainly going to apply to folks. So let's dive in and talk about it. What is that tax bomb? Quick rehash so we don't have to beat it up too much, and why folks should be concerned. I know we've got some kind of bullet point breakdowns for folks to make this easy.
Well, as you said in the beginning, if you haven't had a chance to listen to the previous episode with David Walker, former comptroller of the United States, worked under both Republican and Democrats, I highly recommend you listen to it because he sets up the problem really well.
Yeah.
But for our listeners today, want to just quickly give a quick summary. You know as well as I do, the national debt is out of control. And with that, we have one of the lowest tax environments that we've been in over a generation. So the math just doesn't work out. If you're accumulating a bunch of debt, but you're not taking in a bunch of revenue, the man is going to be calling at some point, and what we believe is that's going to lead to what we're calling the ticking tax time bomb. Taxes are going to have to go up in the future, and that could significantly affect people right when they're getting ready to retire.
Especially if you've got everything in a traditional 401k or an IRA, where many people do.
Absolutely.
Yeah. So that's one piece of it. Let's another piece, right? So the RMDs, that's the other factor of that. So pulling that money out, because again, you've been deferring it. The government says, hey, I want mine, gimme. Well,
Well, the analogy I like to use, and many times we face this with our clients, most of our clients are really good savers. They've put away a ton of money throughout their career, and they have a huge 401k balance or huge IRA. And when they get to retirement, they may not necessarily need to pull that money to support their income. But as you said, there's that little thing hiding, the required minimum distribution, where you're going to be forced to take money out. And if you think about it, at that time, if taxes are higher and you're forced to take money out, that's going to significantly impact your balance. The analogy that I like to use is, would you rather pay taxes on the plant or the harvest? You're planting with a very few seeds, but those seeds can turn into a huge harvest. And that's kind of what we've seen with our clients is over time, that tax deferred account has grown significantly.
Yeah, for sure. Well, and then so that walks us really into our next piece then. So let's just get into the tax efficiency side, because a lot of people, because we have been taught this, we have been groomed to, punt down into the future, right? Just put it in a 401k and just punt to the future. So let's get efficient with the tax funnels. And that's why so many people have been on the conversion train the last couple of years, Jude, because they want to get out of some of that tax defer. They want to get this money into tax-free accounts, right?
Well, part of the purpose of creating the Roth Guy, hence the name, was to help people understand that there is another option, moving money into this vehicle called the Roth.
Right.
Now, we've spoken many times, the Roth Guy is also about tax efficient financial planning, looking at all areas. Mm-hmm. But for this specific purpose, the Roth conversion is a huge potential tool to help prevent from that ticking time bomb
Yeah.
to affect you greatly.
Well, we have three funnels. We have three places we can go, right? We got taxable, tax deferred, and tax free, right?
Yep.
So, I mean, you got three avenues you can take, and we'll pull this up here for folks to look at as well. So looking at, how do we maximize? What do we do here? So break this down for us, Jude. We'll have this on the screen for folks.
Yeah. Most people, from a big picture sense, understand that their money is not all taxed the same.
Right.
But what I find is a lot of people have never seen this in a visual format. So understanding this is very powerful. In the first funnel, the pre-tax funnel, money comes into the funnel, pre-tax, meaning you haven't paid federal income taxes on it.
Right.
It goes into the funnel and it's tax sheltered while it's in the funnel. And that growth can happen without paying any taxes on that growth or the money you contributed. But, in addition to that, you usually are getting a tax deduction because you didn't pay federal taxes on that money. So
right.
that's a very powerful piece.
Yeah, that's those traditional things. That's the 401k, and it's the alphabet soup of the 401k too, right?
Right.
It's all the other ones, a TSP, 403b, yeah.
The whole alphabet soup. You're right.
Yeah.
And so the benefit of this funnel is the tax deduction, but the potential problem with this funnel is, as we stated before, what if tax rates are significantly higher when you need to pull money out or forced to pull money out in the case of the RMD? Yeah. And so at the bottom of that funnel, when money comes out, you'll have to pay taxes at whatever the current tax rate is. And then in addition, if a non-spouse, your children inherit those dollars, then they will be forced to take money out of that account over 10 years. Regardless, that money has to come out and will also be taxed at whatever the current tax rates are.
Okay. So that's that first funnel you guys can see on the left here on the graphic on the pre-tax. Then we go to post-tax.
Now, the post-tax, people are also very familiar with. You've paid federal income taxes. You got a paycheck. You made some money. You took that money and you put it into the funnel, regardless if you put it in your savings account or bought real estate or individual investments. Okay. Every year, if you've made money, you're going to get that friendly 1099 at the end of the year.
Right.
And if you've made money and sold that investment, you're going to pay capital gains. Now, the trick here is to understand, usually capital gains are far less expensive than income tax rates. Okay. So income tax rates could go up to 37% federal income tax rates.
Yeah.
Typically,
so if you're at 22, yeah,
exactly.
If you're like a lot of people are 22, 25, 24, whatever you might be at, capital gains tends to be, there's actually three, right? There's three capital gains and people don't realize that. There's a 0, and there's 15, and then I think there's 20 if I'm not mistaken. But most people tend to fall at the 15, correct?
Most people tend to fall at the 15. So this could be favorable and more efficient than income tax. But, one of the things that I often tell clients is a lot of investment advisors talk about investment diversification. They don't necessarily talk about tax diversification, and that's what we're getting at here. So this post-tax funnel is something most people have. Now moving on to my favorite, the tax advantage funnel. The tax advantage funnel, usually you've paid federal income tax with one exception. That money comes into the funnel, it's tax sheltered, and then the magic here, as you know, the money comes out tax-free. And regardless of what the current tax rates are at the time, you're not paying federal income tax on those dollars.
Yeah. And everybody likes this one, which is why it's so popular recently. Now, we always know the rules can change, but these are the current rules. This is the chessboard that they've given us to play with. So, that's why you start having these conversations about, converting to Roth. And so I know we've got this other kind of an example strategy, Jude. I'm going to flip to that and let you kind of break that down a little bit just to kind of highlight and show some of the stuff for folks. We kind of have a real world example, right?
So here's an example. We'll just call him John Sample to keep things simple. Okay. Very regular client. They have $1 million in an IRA, but they don't necessarily need to pull that money out to live off of. So that money continues to grow. And let's just say, just for argument's sake, that money continues to grow at a 5% rate of return. And that by the time that they're forced to take RMDs, they're paying about 30% on taxes. So
you can see we've got that there on the screen for folks, right?
yeah. So what's the potential consequence of this? Without doing anything else, here's the potential consequences. When you look at it, just based on RMDs alone, if John lives to age 90, he'll have to pay over $729,000 in taxes on just that RMD.
Whew.
And that's significant, right? That's significant. And when you take those RMDs, you're going to do something with the money. Let's just say he takes the money because he doesn't need it to live off of and just reinvest those dollars in a post-tax account, and he's still earning 5%. Well, as we stated before, you still have to pay taxes on those dollars. The taxes on those reinvested dollars could add up to about $198,000. And then, and then John passes away, age 90. Those dollars have to be inherited. Their inherited dollars could potentially pay up to another $704,000 on those inherited dollars. So when you add it all up, that $1 million account could pay over $1.6 million in taxes over his lifetime and the inheritance.
Wow. That's a massive number, right? So it's pretty wild. And so what you've shown here is that if you're now converting, I'm guessing, right? You're moving this over, then this is what we're looking like on the right-hand side.
Absolutely. So one potential strategy is converting those dollars from the always taxable, that pre-tax funnel that we talked about, to never taxable. Now, to do that, you're going to have to pay a little bit of a price. You're going to have to take a little bit of a medicine.
Sure.
But the math works out. If John were to convert that $1 million, he'd have to pay about $300,000 in taxes.
Because he's in the 30% bracket, right?
Because he's in the 30% bracket.
Okay.
But look at the effect over time compared to the taxes he would have to pay by just doing nothing.
Yeah.
$300,000 versus over $1.6 million in total tax.
Yeah. I mean, it's pretty massive, right? And so therefore you got to sit there and think about, am I being as efficient? Now, what we need to do our diligence here, Jude, and say, look,
Absolutely.
If you converted all this at one time, you're going to have an initial tax bill that's not going to be pleasant, like to the $300,000. Right. But you've also maybe bumped yourself up a tax bracket, and so that's some things. So you could even be not in that 30%. It maybe you kicked yourself, depending on your income, up to the next bracket. So just bear that in mind. But it still seems like, to me, that makes more sense if you've got the funds to get it handled.
Yeah, we wanted to show this as a simple example, but there's so much more to it. There's so much more strategy. I wouldn't say anyone just go ahead and convert all of your pre-tax dollars.
Right. Don't do it all at once.
A cascading effect.
People call it Rothing over time, right? So that's a strategy a lot of times advisors will talk about. Let's do a little bit here and there. But the window, Jude, could be closing to this conversation back to the political piece, right? So the window for Rothing over time is now pretty narrow. If the Congress and whomever is president do nothing, taxes are going up.
Yeah, we've talked about this in previous episodes. The Tax Cut and Jobs Act, which brought the rates to where they're at now, will sunset in December 2025. Now, we don't know what's going to happen after that. One of three things. Either they vote the act into law and these rates stay the same. They could come up with totally new brackets, or the third option, which I think is most probable, whoever the politicians are at the time are going to argue with each other, call each other names,
and do nothing.
Nothing's happened. Exactly. And therefore, the rates will revert back to where they were prior to the Tax Cut and Jobs Act, which is more expensive than they are now.
And it doesn't mean you can't still continue to Roth over time. It just means understanding that the historic low rates that we are in will expire if they do that, right? So therefore, you could be paying more on that, which again is why it's very important to have a strategy with your financial professional on doing converting $1 million 401k or whatever you might have.
Yeah. And we haven't even touched on the fact that converting too much could cause an effect on your Medicare, could could cost you even more in current taxations if it bumps you into a higher tax bracket.
Yeah.
I say all this to say you should definitely talk to a financial professional, whether that's a financial advisor who is educated on taxes or a tax professional. This isn't something that I would say, just do it willy-nilly. It's a smart strategy, but it needs to be enacted correctly.
Yeah, for sure. Okay, so we kind of explain what the funnels are. We explained a little bit, kind of a real world sample there with John. So what steps can listeners take to kind of assess their own situation? What's some things we can do?
A lot of the information that we talked about today happens to be on our website, thetaxbomb.com. And so people can go there, they can see some of the information, but more importantly, they can take the tax bomb calculator and see what the potential tax liability is in their own accounts. And so I would highly suggest that to just start the process and understand what's the potential in your financial life.
Yeah, for sure. And you can check the show notes, folks. We'll have the links into there this week, as we always do. And we've had it pop up on the screen as we've been going along as well. But it's thetaxbomb.com. And it kind of helps estimate future tax liabilities and potential savings with different strategies. So there's certainly some good tools there. So Jude, as we wrap things up, any final advice, any thoughts? I mean, you've been doing this for years. You've been helping people get to and through retirement. And I think people are beginning to wake up, I guess, hopefully, and good that they're doing so, that taxation really, we know it's a problem in our everyday life, but I don't think we've really put the forethought sometimes into what it does to our retirement. And maybe, even though income is probably still the king conversation, making sure that you have income coming in retirement is important. Taxation is right there, man, because it could totally make or break that whole thing.
For sure. And, as you said, we're winding up. I want people to walk away understanding, we're not one of these conspiracy theorists that say there's somewhere in the Constitution that tells you don't have to pay taxes. It's a fact of life. But how we approach this, using every tool available to us, really makes a difference over time.
Yeah.
And so I implore everybody that's listening, really take a look at the tax bomb calculator. It's a great place to get started, but talk to a financial professional, because every dollar you spend unknowingly and unnecessarily is less money that can accumulate for you, compound, and leave a greater legacy to your kids and grandkids.
Yeah, for sure. And there's so many facets. You mentioned earlier what taxation can do, what income levels can do, where you're pulling from, when you're pulling from, so on and so forth. It can affect the IRMA, all kinds of things. So there's just all these little ripple effects that can happen. And, building wealth, and we talk about this often, is a little easier than, than doing the preservation of it and the distribution of it, which is retirement. So if you need some help, reach out to Jude and his team. Get onto the calendar. All the information is in the show descriptions for this week's show, and you can find all that stuff there. Hit the subscribe button and the like button to catch new notifications, or the notifications bell, so you catch new episodes when they come out, and all that good stuff. And go check out the David Walker episode if you did not. It does set this one up nicely and maybe kind of helps you kind of see what's going on there. But Jude, I think you did a great job breaking that down for folks, making it very simple and concise that they can kind of understand, just what they could potentially be looking at. So get your tax efficiency game on. Reach out to Jude and his team, and we'll see you next time on the podcast. Thanks, buddy, for hanging out.
Hey, thank you. This has been great.
I always appreciate your time, my friend. We'll see you next time here on The Roth Guy, and hit that button. We'll see you next time so you can catch new notifications and new episodes. Bye-bye.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Centrus Financial Strategies and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Centrus Financial Strategies are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website. www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form 80V from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.